And so, I'm sorry, live is, you mean you have, so some people are going to be watching it live, and are they going to be talking or writing in questions? Either way is fine. I just guess.
So I actually, this is, I have a YouTube channel that's got a decent following, and I can't do content over there because it gets censored. But for this episode, me and you, we're on that channel right now. So I'm going to guess as
Oh,
we get going, we'll get a fair amount of people here with us live, and then they'll post comments on the side. And as we go, we can kind of take the comments in. It's fun.
oh, I see. Okay. Oh, they'll post. Oh, they'll be postings. Yeah. Okay. That's good.
Exactly. All right. So let me introduce you. We'll get to it. Welcome, everybody. It is part 2 of our series on our love of capitalism. It is. We took a break in the middle last time because there was such a wealth of knowledge. I needed time to process it. Gene, welcome to the show. And there's a SOA form coming up that I'm gonna be opening up for. Why don't you tell the fans?
That's right, Robin. You're going to be paid $200 worth of shitcoin for that service, and that's what comes to maybe $1 a joke. There'll be 200 great jokes that you'll cram into those 8 minutes. And so I'm getting quite a bargain from you, Rob. And I've seen you on the stage, and you kill it. At your best, you kill it. I saw you, and then Dave Smith followed you. You were both fantastic. You both knocked it out of the park. And I want you, for particular reasons, with all due respect to Dave, this is going to be a very hot subject that night. It's going to be all about military power deterring China from invading Taiwan. And Dave has become such a political figure. I'm a little bit afraid that he's going to, touch off some kind of controversy in his warm-up. So you are safer, Rob. You're safer.
My opinion's already known on this topic. I've already publicly declared that I thought Russia should take Taiwan. So I'm not controversial anyway. I've already made my opinion clear.
Precisely, Robin. You just like to tell jokes about Chinese restaurants, and you'll work that angle on the China issue.
Exactly.
And, that's why I want you. You're sort of one of those old-fashioned Jewish comics, and that's why I want you warming them up with just a sort of a Borscht Belt kind of approach, if you know what that expression means. Having to do with the Catskills, where all the great Jewish comics used to hang out, like Jackie Mason. And so you are going to be the warm-up act. And this is like after months in the wilderness, this is the sole form to attend. Why? Because at the Sheen Center at 18 Bleecker Street in downtown Manhattan, there will be no vax or mask requirements. And that's why a principled guy like Rob is willing to take the stage, because there will be no vax or mask requirements. Mayor Eric Adams, I'm beginning to like him a little bit better, certainly a heck of a lot better than the previous mayor, Mayor de Blasio, did lift all vax requirements for restaurants and public venues as of March 7th. And a lot of venues are following that happily. Some are not quite, but in any case, he lifted them. I don't think de Blasio would have done that. And so New York City is beginning to open up again to reasonable people. And that's very heartening for me as a denizen of downtown Manhattan. So again, no vax or mask requirements, and that's after many months. And Rob, you you wouldn't appear at the last time around when I had to impose the vax requirements, but at least you haven't repudiated me. You and Dave and Tom Woods, you've stayed loyal to me personally. You've forgiven me, cut me some slack for the fact that I was running these debates at places that did impose vax requirements. But now, happily, this is the homecoming. All of you out of towners who enliven our debates so much, please come to New York City. That's going to be on Monday evening, April 11th. There's enough time. I guess what, Rob, if you fly in, I guess you have to have vax requirements on the plane.
No. I've been flying all over the country. There's no vax requirements for planes.
Oh, okay, dude. Oh, well, I'm so ignorant. I haven't flown in months, and so I did have to. What am I talking about? Whatever it is, Rob. I'm an ill-informed guy. Well, that's good. So fly in, come in by train, plane, bus, or automobile from
hitchhike.
Hitchhike, exactly. And sorry for belaboring this ad too much, Rob, but I've got to take my time to say that this is going to be the sole form of the year, Monday, April 11th, and that's again the doors open at 6. The proceedings start at 6:30. At around 6:34, I'm going to bring Rob Bernstein on as the warm-up act, and then the debate begins, and then there will be a reception in my home. I've gotten into that now format. My home is only 2 blocks uptown from the Sheen Center, and I think it's a good place. More sort of a funky atmosphere to have a reception. And we in the last reception, where there were no vaccine requirements, and where Rob did do an informal warm-up act. Look, Rob is willing to appear in the men's restroom of any bus station, as long as you bring enough attendees, because Rob just practically gives away his jokes. His jokes are invaluable, but he's willing to give them away. That's because he is a sweet and generous guy. So anyway, what else should we say about the Soul Forum, Rob, that I haven't said already 5 different times? Yeah,
I think you covered it. It's a good hang. You got meatballs in the back. You can have a beverage.
Food. Okay. Yeah. Look, Rob is a Jewish guy. He stuffs the food down. He brings it. Yeah, indeed. My wife is going to be catering the event at our home, and so of course Rob is looking forward to the food, just like any other Jewish guy is. Yeah. Yeah.
And I also, the events are very informative, but I also find that they're ADD friendly, because you know exactly how, like, you're never stuck in your seat wondering how long this thing is going. And everyone's kind of has their time commitments. So they got to get their point across. And before you know it, you get to the questions and you're like, that was the perfect amount of time for me to. So I find that, like, the flow of the events are really friendly for people like me.
Oh, thanks, Rob. No, there's in most of our debates are an 80-minute format. We have to respect the clock, and I've got somebody in the front flashing cards when they're running out of time. So indeed, but 80 minutes for a one-on-one debate. People can speak in paragraphs. There are questions from the audience. There is, in fact, of course, as you know, the before and after Oxford style vote. You vote on our little. We have a program for this. You can access on your smartphone, and the audience votes yes, no, or undecided on the resolution. In this case, it's going to be the U.S. should use its military power to deter China from invading Taiwan. And you vote yes, no, or undecided on the resolution before the debate begins, yes, no, or undecided on the resolution after the debate ends. And whoever moves the vote in his or her favor wins the Tootsie Roll. I literally toss a Tootsie Roll at the winner, who invariably...
Those are old school.
So it's actually kind of a theatrical evening because there's a conflict between two people, and then there's a kind of a resolution at the end because of the Oxford style voting. Yeah.
All right. So let's get into it right off the bat. My question for you, Gene Epstein, is let's imagine a theoretical world where you're in charge of the Fed and your decision is not to get rid of the Fed. So you're in charge. You respect that the institution is supposed to exist and that you have to mandate what the interest rate's going to be and predict inflation based on the interest rate that you're imposing on the economy. So I hand it to you to maybe give us a little bit of a picture here of what this tiny percentage increase, if it like, what's your inflation expectation over this next year? Are things going nuts? Is it because of the supply lines? Is it because of the money printing? Take it over. You know more on this topic than I do.
Okay. Well, that's okay, Rob. You want to talk about inflation?
Interesting. A little bit.
I just want to inform the audience that Rob likes everything free flowing and unpredictable because Rob actually emailed me. I've got the documentation. He talked about the first question he did want to ask, having to do with the oil price. So I'm open.
Oh, I skipped that. We can start with the oil pricing. That's a fascinating question as well.
Okay. Well, it sounds as though the theme is going to be mostly price inflation rather than a continuation of the bleeding heart capitalism, which is fine. In any case, Rob, I'm actually fine with answering the first question you asked because the oil price is a different question. You found it kind of interesting, having to do with what happened when Biden announced that the U.S. was no longer going to buy Russian oil. You were interested in that, or am I mistaken? It was
no. I thought that was fascinating. So I'll set that up. We'll go in order. Look at me. I was jumping the gun on inflation.
Inflation relates to it, of course. Yeah.
No, but we'll go with the oil to start off. So the entire world hopped on when Biden said, "Hey, we're not going to buy Russian oil." Every single media organization is going, "Oh my God, oil is already going up in price, and it's going to go even further up in price." And Gene, I was even, talking this narrative, and you said that's a load of hooey. That's not the way it works. So I handed it to you to us because it was interesting, and I did have it wrong.
Well, for the most part, it is a load of hooey, and I would point to the fact that the world price, the Brent price of oil, has been pretty flat since Biden went up and it went down. It hasn't really resumed any upward rise since Biden made that announcement, and that was a couple of weeks ago. So therefore, that would be evidence enough that the fundamentals are with me rather than with people such as yourself, Rob, who believe that was a time to. Did you go long oil futures at the time, Rob, and lose your shirt? Because
No, of course not. I figured the second it's already made the paper, you're too late.
Oh, that's an old saying. Yeah, when the market makes the front page of the New York Times, then we know the market rises over.
I'll tell you what I did lose my shirt on was Zero Hedge did an article about buying Russian ETFs, and I lost just about 100% on those.
You bought
the Van Eck Russian whatever.
Not that you bought those czarist bonds, Rob. But then they overthrew the czar, and the bonds were no good anymore. So that was another. Anyway, but again, with respect to the oil market, it's only that when Biden says we're not going to buy any more Russian oil, ironically, most of Russian oil that's sold in the market isn't even bought by the U.S. in the first place, and a number of other countries didn't quite join Biden in that. But that's really less important than the fact that by and large, the oil market is like one big swimming pool. We often talk about it being a bathtub. It's really one big swimming pool, and that the sellers put the oil into the pool and the buyers take oil out of the pool. And it doesn't really matter whether they're taking oil out of the shallow end or at the deep end of the pool, or the north end or the south end of the pool. The point is that we've got many countries that sell oil in the global marketplace and many countries that buy oil. And if country A is no longer buying from country B, then country B will sell to country C and D that oil that wasn't sold to country A, and country A will buy its oil from countries F, G, and H, and there's just basically a realignment of the oil market. Now, that's a slight exaggeration, because I've been reading some stories about how Russia has been marketing its oil at a discount in the market because some countries have been reluctant to take it. But essentially, of course, if you've got oil to sell, you're going to be eager to sell it. If you want oil, you're going to be eager to buy it. And the Russian oil that the U.S. is not going to buy will find its way into the market one way or another. As I said when I was speaking to you, we've literally had cases of oil tankers on their way to one country, suddenly getting particular news, and then veering in another direction and getting on their way to another country. So it's almost like the adjustments can be instantaneous, but it isn't always instantaneous. And of course, the oil market is a fascinating mix of politics and economics, and is, of course, of just what happens on the high seas. So it's a little bit of a mystery where the Russian oil is going, but by and large, it didn't into the pool one way or the other, and however it goes in or is taken out is pretty much beside the point. So that's all the only lesson. I guess you thought that was of interest, Rob, what I said.
So then, I mean, this is a good segue into the inflation conversation.
Yeah, okay,
so in your estimation, is the reason why gas prices are where they currently are, is that a signal of inflation? And what?
Well, as a matter of fact, I have to say, I don't have a complete explanation as to why the oil price has risen so as far as it has, up to nearly $100 a barrel. There was some crazy stuff went on in the market the last couple of years, having to do with the fact that at one point, by the way, do you know that the oil price went negative? For the first time in the history of humankind, during the lockdowns, there was so much oil sloshing around in the world that people were paying to give it away, and for a brief time. Give it away.
That was like a 1 month thing, and I bet.
Yeah, well, okay. Yeah, all right, all right, all right. Look. You're admittedly, I'm a Talmudic scholar of prices, and you're just a generalist, Rob. So I just found that fascinating.
Right.
My God, I'm paying you $1 a barrel, $2 to take oil off my hands. This was years after they said, well, oil's going to $200 a barrel. So so it looked as though the oil suppliers got such a shock from that they didn't expand capacity, and then Biden comes on and he wants to choke off any expansion in the oil supply. And so it looks as though that sort of led to a scarcity of supply and the oil price jumping to $100 a barrel. Now, I'm being overly simple when I say that. And by the way, you can see that I'm not mentioning the Federal Reserve when I talk about the oil price, because for the most part, it really doesn't belong in the story, but you can bring it in a bit. Because the basic rule of price inflation is that unless there is an expansion in the money supply, that's a slight overstatement, because it has to do with, to some degree, with the money that people want to hold and whether they want to hold less, and then more money is spent. But by and large, it's determined by whether there has been an expansion in the money supply. The expansion in the money supply will bring an increase in the general array of prices. But if there is no expansion in the money supply, then if the oil price goes up, that doesn't mean there's really price inflation as we normally use the term, because all it means then is that people will have to spend money on oil, on gasoline, on heating oil, more than they usually do. That leaves less money for other things, and with less money available to buy other things, those things will tend to go down in price, and so the general array of prices will remain about the same. In a normal free market, the prices adjust to each other. If something becomes very scarce and a lot of people really want it, if there is, as we economists say, inelastic demand for that product, and that's of course true of energy, we consumers need a lot of it, and if it doubles in price, we'll cut back a little bit, but we can't cut back by that much. We have to drive our cars and heat our homes and turn on the electricity. We'll spend more on that and less on other things. So again, it's a fundamental rule, of course, that only with an increase in the money supply can we get a general increase in the array of prices. But to get back to your point about oil and gasoline and heating oil, there was an absolute explosion in the money supply over the last 2 years. By an explosion, I mean, more precisely, a measure of money known as M2, which is a very, very conventional measure kept by the Federal Reserve for years. The M2 includes cash, checks, and savings accounts, money market funds, those things that we normally call money or near money. The money you have in your savings account that's not in your cash, your checks, is money you'll tap. Money market funds, that's the measure called M2. And over the last 2 years, 24 months, it's jumped by over 40%. In other words, just 40% of all the M2 that ever existed was created over the last 2 years. Now, that's unprecedented in terms of the numbers that the Federal Reserve has been keeping going back to the 1960s. The biggest jump prior to that was in the 1970s, when it jumped by about 29% in 2 years. A couple of times there were spikes of about 29%. We've had now 41%. And what happened in the 1970s? Well, the 1970s were also a period of very high price inflation. Double-digit price inflation in many years during the 70s. So again, I only link that up because my point is that clearly M2 has something to do with price inflation. But of course, logically, as I say, an expansion of the money supply is what drives inflation. And to my amazement, I read again. Rob, you going somewhere? What?
No.
I'm boring you, Rob.
Not even a little bit. It said that my battery was going to die, and I realized I hadn't plugged in the cord.
All right, the usual problem with the technical problems that interrupt my flow, but that's okay. But anyway, so getting back to your question, if you want to link the oil price with the money supply with the Federal Reserve, then we do have somewhat of a link. On the other hand, I will say that the jump in the oil price was mainly sort of supply driven, and given the scenario I sketched a few minutes ago about what seemed to have happened with supply. Right now, by the way, it's interesting that a lot of small producers of oil are going bonkers with glee. They are the small producers are expanding, domestic small producers of oil, relatively small. They are expanding their oil supplies very rapidly right now, and they're getting like $90 a barrel, $95 a barrel. They are on their way to becoming billionaires at this rate. I don't quite know why the majors are not expanding, but the domestic oil market, which consists of a lot of frackers, a lot of other smaller companies, is expanding the oil supply. So it is a price looking for a greater supply, and to some degree, it is finding it in domestic oil producers. But that's the oil story. You began by asking me about the Federal Reserve, and you threw me a difficult question. You said, no, you can't end the Fed. No. No ending of the Fed. It's now Chairman Gene Epstein. I'm now chair of the Fed.
Yes.
The old line, what if they made you dictator for life, and what's the first thing you do? Chomsky used to joke, I'd resign. What if they made you chairman of the Fed? My answer, well, I'd resign. I'd say, no, you've got to end the Fed. I don't belong in this Soviet style organization of trying to allocate the price, the most important price of all, the price of money, the price of credit, the interest rate. But you've asked me the stumper, Rob, because you like to be hard on me and get me at my best. Draw me out and give me questions that are so difficult. Not even Chairman Powell can answer them, and not even Dave Smith. So I'll answer the question, Rob.
But before we get to the stumper, I actually think that there's a building block that maybe we should add to the conversation, which is, if we look at oil and we say, hey, it does seem like this isn't entirely price inflation, but it's somewhat in regards to supply line issues. So do you think that some of the other prices that we're currently seeing in the market, most notably, I guess, in meat, or what people are saying they're seeing at like the shopping mart, when they're going shopping for food, do you think some of that is also supply line related? And that with COVID, we shut down factories, or you've had all these situations with ports? Or do you
Rob,
think, yes,
I've got to grade you down. Look, Rob, if you're going to talk about the general array of prices, if you're not only talking about the oil price, and indeed the gasoline price does respond to the oil price, definitely. People who sell the stuff at the pump, if they're paying a pile of dough, if along the pipeline the crude oil costs a lot, then the gasoline price is going to rise as well. But if you're now talking about the whole, if you're not broadening it to what I prefer to call the array of prices, that's a word that an Austrian would use. They're not the price index, but the array of prices. If you're talking about all of these prices, food, cars, services like massages, all of these prices that are rising, then, as I've said, if it depends on what's happening with the money supply. Why? Because now we're talking about all the prices. Because, as I've said, if the oil price is spiking and gasoline price is spiking and heating oil prices are spiking, then you and I've got to spend more on this stuff. But if there's no more money in the system than there was a year ago, then on balance, on average, we consumers have less money to spend on these other items, and so even if supplies are having a problem, we're going to be spending less on these items. So you're not going to see very much of a rise in the general array of prices, if the money supply remains flat, because what goes for what that much more that goes for gasoline and heating oil will be that much less that goes for other things. And so it's a little bit of a confusion to say that this has been a general supply side issue having to do with supply chain problems. So again, I'm oversimplifying a little bit, but I'm trying to get us down to earth and recognize that if the money supply was stable, and they're stable. In fact, money supply is stable, and the more goods, then prices will be generally falling. But and again, I'm not saying the supply side isn't affecting things a little bit, but as a general approximation, it's a complete confusion to talk about how the supply side can be driving the general array of prices up, or the price indexes as conventionally measured, the consumer price index, the personal consumption expenditures, a price index. Those price indexes cannot be driven up unless there's an expansion in the money supply. You see the logic. If there's no more money, then we just have that much less to spend on other things. If indeed the oil price, of course, is unique because of what we call inelastic demand. It does mean that if the oil price rises, then gasoline and heating oil will become more expensive, and we're going to be spending more on those items because of inelastic demand. If the price of peaches rises, Rob, then you'll obviously eat more nectarines. So the price of peaches isn't even going to affect very, very much. You won't pay that high price for peaches. Very few people will, but you will when it comes to energy. So of course the energy will indeed bring about price declines in the other items because the demand for energy is inelastic. Have I explained it well enough, Rob? Or are you still dubious about what the heck?
No. So I do have one question, but essentially, the biggest indicator of inflation is the M2 money supply. We've had it at the highest level ever, which is 40%. Right? It was a 40% increase. And we have a general rule that the only reason you would see prices raising across the board is because of price inflation. Because if not, you would just see what?
Because of price inflation has occurred because of an explosion in the money supply. Price inflation, which refers not to an oil price rise, but to the general array of prices. Most prices are up.
Now, couldn't an increase in specifically the energy costs, because what you're saying is if I got to spend more money on energy, and let's say I rent out hotel rooms, I know that people are spending more money to get to my hotel, so I'm going to have to reduce the rate of my hotel rooms because people have less money to spend on the hotel.
Unless you do, they will have less money. I mean, this is almost a matter of simple arithmetic.
But don't you also have, though, that there's a rate of profit that everyone's looking for. And so if I have to spend more money on gasoline and the energy to operate my hotel, then I'm forced to increase my costs. I mean, I'm forced to increase it because otherwise I'm going to be like, I'm not hitting the profit that I need. Like, doesn't in some way the energy costs actually push everything up because people are going to demand more because operating costs them more?
Well, you ironically, without realizing it, Rob, have put your finger on something else that's in common parlance, which is called the potential for an oil price shock. Now, I don't deny that these things can happen, even though I think that when we look back on the so-called oil price shocks, I don't think that it was really the oil price that did it. But what does an oil price shock do? An oil price shock is often what they blame a recession on. What is a recession? It's a wave of bankruptcies. A lot of businesses suddenly can't function. They can't make a profit. They shut down. They start laying off workers. So it's a wave of bankruptcies across the economy. And how does the oil price shock bring it about? Well, the oil price shock can bring it about more or less for the reasons that you stated. Suddenly, the businesses have to pay far more for oil. Everybody else has to pay far more for oil. So they're suddenly, and they can't, because there is no increase in the money supply in this example I'm giving, or not enough of an increase in the money supply. The consumers of that motel you mentioned, is that the example you cited, can no longer cannot afford what the motel would like to charge in order to stay in business, and the motel realizes it. There's not enough demand, and so the motel suddenly shuts down and lays off all its workers, and that happens across the board. So there's no question, by the way, that any market economy is vulnerable to shocks. And I mean, that to some degree segues into the argument I make about Austrian business cycle theory, which is that we Austrians talk about what mainly causes recessions, having to do with malinvestment that can no longer function. But I leap to say that that's not the only potential shock that a market economy would be subject to. An oil price shock is conceivable. The example that I used to like to cite is, let's say everybody goes kosher tomorrow morning, and nobody is going to buys non-kosher food as of tomorrow morning. All that non-kosher food is on the market, but nobody's going to buy it. There's going to be a wave of bankruptcies, a wave of people businesses laying their laborers off, and that could cause further problems. A market economy does have shocks, and then it has to adjust to those shocks. But to go back then to your point, no, Rob, if there's a flat money supply, then it's not as though all of those businesses can raise prices. They'll simply have to tolerate charging lower prices and see if they can survive. Their costs are going to rise, and their prices are going to have to either remain flat or down, because people will not have the money to afford those items, because they are already spending a lot more money than they used to on energy. So that's why energy matters. So you're talking about an oil price shock that could bring a recession, a wave of bankruptcies. You're not talking about an inflation response. Again, follow the arithmetic, Rob. If there's only 10 trillion, matter of fact, I don't even know my M2 numbers offhand. There's only 10 trillion M2 in the economy, and a year later there's still only 10 trillion M2, no more money than there was the year before. Then prices are not going to rise in general. If the oil price rises substantially, all that will happen is the oil price will rise and other prices will fall accordingly, and the general array of prices will remain approximately the same. But if there is that oil price shock, and if it makes it difficult for a lot of businesses to function because of reasons I stated, it could bring a recession.
So just to put it in very simple terms, if you own a business, you want to charge more money for your services. Plain and simple. If you want to make more money as opposed to less money. So
I hate it Rob, I'm going to let you finish that, even though I hate when you say that, but go ahead.
Okay. So if every single business finds out that they can raise their prices and people will still purchase their items, there's only one reason why that could have happened, and it's inflation. And then if you look at the M2 money supply and it's increased, then you've solved your puzzle.
Okay, just more. Okay, raise up. Okay, all right. You sort of rescued your point about raising prices, because I like to make the point that so many of the major fortunes have been made not by raising prices but by cutting prices. And that a businessman wants to maximize profits,
right?
And the different ways of doing that: improve the quality of what you sell, convince those people that the quality is so special that they should pay more for it or should buy more of it. But another way is to simply cut prices for standard items. And that's basically how Jeff Bezos became a billionaire. At least that's how he catapulted himself. That's how Sam Walton became a billionaire of Walmart. Sam Walton of Walmart. He basically sell name brand items in large stores and cut the prices, and that's how you become a billionaire. But okay, that's a bit of a digression. Getting back to the point, you're now trying to talk about a scenario of inflation heating up, and what's my point there? I want to throw in a footnote about that M2. I want to say that the source of that explosion in M2 is essentially that the Federal Reserve has also seen an immense spike in the purchase of government bonds. There's a chart kept by the St. Louis Federal Reserve on how many bonds issued by the U.S. Treasury has the Federal Reserve bought over the last year, over the last 2 years. That too has exploded. How does the Federal Reserve buy those bonds? It basically prints money, creates the money with which to buy those bonds. So
we're financing more of our own debt.
Financing more of our own debt, exactly. So through the explosive purchase of those bonds, M2 has exploded. Statistically, it's difficult to trace the one from the other perfectly, but fundamentally, that's the connection. So the money basically goes into the hands of government. Government spends the money, it floods into M2, it causes price inflation, and so that's pretty much the scenario. And interestingly, you still haven't. You're backing off on that question. If I were
no, I was about to set it back up. So that brings us to we're looking. You're in charge. You're looking at the chart. M2, 40% increase. No, price inflation's coming. You got to make a decision to raise interest rates because someone's got to make the decision. And we put you in charge. You got to make it. What should we be raising it to?
I take over from Chairman Powell as of Monday morning.
Yes.
All the destructive policies that Chairman Jerome Powell, he's the chair of the Federal Reserve. For those who don't precisely recognize his name, I hate to just mention a million names and people don't necessarily know. Chairman Powell, he's been in the news. He's been head of the Fed. I take over from him, and what do? Well, I recognize one fact that stares you in the face. Here too, I've thrown up a chart about this on Twitter. You can we actually have the history of the targeted interest rate by the Fed is called the Fed funds rate. The Fed funds rate is the overnight lending rate between banks. Banks lend money to each other overnight, and the Fed mainly targets that interest rate. Targets it by either actually an announcement effect can often target it. It targets that interest rate by buying and selling bonds and focusing on the interbank market by so doing. We could set aside those particular logistics. I'm only setting it up for the Fed funds interest rate, which is historically the main interest rate, the short-term interest rate that the Federal Reserve has used as an instrument of policy. But what's the next part of the story? From 1960 to 2010, over a 50-year period, that Fed funds interest rate was almost always above the rate of the 12-month price inflation. If you just put the trailing 12-month price inflation, from December to December, January to January, February to February. The rolling 12-month rate of price inflation measured by the CPI or by the PCE, then take the Fed funds rate. The Fed funds rate was generally higher, almost always higher than the rate of inflation from over the 50 years from 1960 to 2010. Although by 2010 it began to slip. And in the 1990s, of course, I guess you're too young to remember that. The Fed funds rate was at 5%, 5.5%, and the inflation rate was 2%, 3%. So it was normal for the Fed funds rate to be above the rate of inflation, as measured by the trailing 12-month interest rate, the 12-month rate of price increase, as measured in that way. And so we took that for granted. Why do you take that for granted? Because these interest rates are rates at which people lend and borrow. Because if who is right,
pay me more returns than just inflation.
What?
You'd have to pay me more returns than just the inflation.
Exactly. Who in his right mind is going to lend money at below? Now, mine is a crude measure because I was dealing with the lagged. The 12-month rate lagged, but it's approximately right because the 12-month rate lagged was usually what was happening over the following 12 months. So it was a general measure of the relationship between the interest rate and the rate of price inflation. And just as you said, as I'm about to say, who in his right mind who expects price inflation to be 5% would lend money at 4%? To me, unless somebody's really forcing you in a free market. If indeed a free market did have a 5% price inflation, I could set up a hypothetical where that could be the case, even though it's very unlikely in a free market because the money supply isn't going to jump by that much, but it's not inconceivable. I could set it up. There would be an adjustment. The lenders would it would begin to insist on what we in the economics parlance call a real rate of interest. The real rate of interest is, of course, the inflation-adjusted rate of interest. So again, I've been, I think, maybe rather garrulous and simply talking about how in those 50 years from 1960 to 2010, the Fed funds rate was above the rate of inflation. Since 2010, which has now been 11, 12 years, going on 12 years, the Fed funds rate has been below the rate of inflation. Now this is now more than a decade, and I'm just looking at conventional numbers. I'm almost talking in conventional terms. If I were a congressperson and I didn't have much imagination, and my assistant put this in front of me, I would say, Chairman Powell, 50 years of the interest of the targeted interest rate being above the rate of inflation, and for the last 12 years it's been below. Why this departure in policy? You're a pretty radical guy. What the heck have you done? What have you wrought? And now we find that that the plans, when we're looking at 6% inflation, 5% inflation at a minimum, the plans are to raise. What happened last week was the interest rate was raised to, I'm even forgetting them, to something like a quarter of a point, or was it one less? It's still less than half a percentage point. So, and what is going to be raised to over the next year or so? The ambition is to raise it by small degrees up to 3%. 3% still below the 5% rate of inflation that seems to be, or 6% that seems to be plaguing us. And so what kind of inflation fighting policy is that? And again, I'm hardly sounding like some kind of, I hardly need to be any kind of extreme free market Austrian to make that point. The Wall Street Journal is making that point. The Wall Street Journal, is basically sort of oriented toward the free market, but they do believe in the Fed, and they're not too keen on Austrian economics. My point is that this is just insanity. Insanity just in relation to the 50-year policy of the Fed prior to 2010. So that's the reality of what's going on. And on top of that, we have Biden and other fanatics talking about how the government, Joseph Biden, because you've heard of him, he's the president. He does not. He specifically repudiates the idea that the government has anything to do with the price inflation that has arisen. And then we have so many left wingers talking about how it's all about corporate greed, or all about some of the crap that you've been handing me, Rob, about how it's all supply chains. When I try to belabor the point that again, it's got to be the money supply. Arithmetically, it's not possible for it to be otherwise. So the picture I'm painting is that if I were chairman of the Fed Monday morning, it would be a difficult education that I would have to impart to the White House, impart to the media. I would have, but hopefully, if I threw up that chart, I'd say, look, I'm a conservative Federal Reserve chairman. I want to return to the 50 years from 1960 to 2010, when the federal funds rate was above the rate of inflation. I need to target that. We've had 11 to 12 years of insanity of fixing an interest rate below the rate of inflation, and I'm inheriting a Fed that now plans to raise it to 3%, still below the rate of inflation. And so that's the burden that I would have to take on, and I would declare my aim to lift the interest rate above the rate of inflation. Yeah.
Firstly, fascinating and insightful, because I was unaware of any of this. So I appreciate, and it seems pretty crystal clear when you put it that way. Hey, we've been running with this metric for 50 years. Like, why are we not running with that metric? My question for you, though, it's kind of a technical one, which I think also amplifies the mistake that Powell is making at this time.
Yeah.
So the question is, so I would assume that the way that the Fed is manipulating the Fed fund rate to keep it below the rate of interest is that they're making money available to the banks so that they can, I guess, afford, like, what specifically is the process of them being able to manipulate that Fed fund rate to keep it below the rate of interest? And I assume it's that they have to
stop saying the rate of interest. The Fed funds rate is an interest rate below the rate of price inflation. below the, you said, wait a minute, they're keeping
Okay,
the Fed funds interest rate below the rate of price inflation.
Below the rate of price inflation.
Yeah.
I would think that you have to be making money available to the banks, which would then increase the money supply,
Yeah.
and then also increase the exact problem, which is that you've increased the money supply so much that there's more inflation. So it sounds to me like that the exact policy would be basically just fueling more inflation.
Okay, all right. There you've raised another good question. Finally, Rob, please with this, watch it with the economic grammar. Admittedly it's a little bit difficult, and I don't know if we've lost the audience because I'm speaking with a lot of you. This is like Fed speak. I'm trying to explain it clearly, trying to get it across. It is called the Fed funds interest rate, and I latched upon it because has been the targeted policy since 1960 and before. So that's why it's got that history. That's why I wanted to mention this 50-year history. But getting to your question, you do hit upon an issue. If you flood the market with money. By the way, what's also been happening as a departure from the past is that the Federal Reserve has been buying up, has been targeting interest rates all along what we refer to as the yield curve. In other words, it hasn't just been targeting the short-term interest rate. It's been unprecedentedly starting what's known as QE, QE2, QE3. It's been targeting mortgage interest rates, 10-year interest rates by buying up. If you buy a bond that has a fixed coupon and you raise its price, you lower its interest rate. You lower the difference between the price of the bond and the return on that bond. So it's been buying up bonds all along the yield curve in order to lower all the interest rates. So I'm giving you my usual garrulous answer to your question, which does have that glimmer of brilliance, that usual glimmer of brilliance, Rob, when you ask, well, but if you're flooding, if you yourself are causing the inflation and you're flooding the market with money, doesn't that mean? And now I'm going to use a phrase that was common in the 90s, not so common anymore. What they used to call the bond market vigilantes. The bond market vigilantes was a nice phrase because the vigilantes are always citizen, the vigilantes, of course, Rob Bernstein commits a crime. The vigilantes, hang him high because he's committed a crime, and so on. The vigilantes then are not government. The vigilantes are just the private citizens. So who are the bond market vigilantes? The bond market vigilantes are those who say, hey, look, the goddamn inflation rate is 5%. Money supply is going through the roof. Who the heck? We've got to dump our bonds. We can't hold these bonds that are only paying 2%. We've got inflation at 5%. So the bond market vigilantes, the traders, the citizen army starts dumping bonds, and by dumping bonds, the prices of those bonds fall. And if the prices of those bonds fall with the same fixed rate of return, the interest rates start to rise. And so I use the phrase bond market vigilantes because it was a nice phrase that captured that phenomenon. Although, of course, it sort of implied that the government should have some role in the bond market. Really, it shouldn't. The vigilantes, the traders should be in charge in any case. But your question is, how can this continue? How can people continue to borrow and lend at interest rates below the rate of inflation? How long can the Federal Reserve keep this going? Because won't we have, and now to put words in your mouth, won't we have a market response in the form of the bond market vigilantes? Won't we have a reaction? And that has puzzled me that we have not had it yet. The Federal Reserve now has been so dominant, and I guess the degree to which the traders sort of trust the Federal Reserve has been so great that we do have this craziness. We have long-term bonds that are going for only a little over 2%, when one would think any rational person would recognize that the inflation prospects over the next 10, 12, 15 years are certainly for a higher rate of inflation than 10, 12, 13%. So to answer your question, I believe that inevitably this is going to bite the Fed in the ass and that the interest rates are going to rise. But I will say that at least the Fed is marching in the right direction now. At least it is raising interest rates, but it is the plan is to raise the Fed funds rate by 3%. My point is that I would have to declare as Fed chairman that that's not enough. We've got to catch up and then start exceeding the rate of inflation in order to go back to where we were, the policies pursued by my predecessors from 1960 to 2010. It's a little uncomfortable for me to talk like that because I believe a lot of those people were jerks, who headed the Fed for those 50 years, but at least they were less insane, less crazy than Chairman Powell is. At least they did something reasonably sane by maintaining the Fed funds interest rate above the rate of inflation. But again, my usual garrulous answer to your question, Rob, which is that the market will probably respond sooner or later by raising the interest rate. We can add further that there's an insatiable demand on the part of the government to continue to borrow in order to finance its spending plans over the next 10, 20 years. So one way or the other, we are headed for real problems down the road. I believe that we are on a trajectory of increased price inflation over the next 10 years or so. But you wanted to say something.
No. So I guess just to slightly add to the picture that you're painting. So at some point, there's only so much of the debt that the Fed can just buy without continuously pushing up inflation. And so they're going to be in a situation where they're forced to basically raise interest rates and actually finance some of the debt by selling bonds, not just to itself.
Well, yeah, they're beginning to move in that direction, and they're beginning. Last week, it was announced that they're raising the target by it was a quarter of a percentage point, and that the plans are to continue to inch it up by a quarter percentage point up to about 3%. They hold an immense amount of bonds. They're going to stop doing that. All the Fed has to do, by the way, is simply stop expanding its holding of bonds because those bonds mature. So its holding of bonds will simply wind down if it simply stops buying more bonds because bonds mature and disappear. That's the nature of a bond. You own a 20-year bond, it matures in 20 years. It no longer exists. Bonds disappear over time. So they can do that. So they are taking baby steps in that direction. My point only about price inflation is that it's clearly they aren't doing enough, and they're acting in an atmosphere where what I've just said, I guess I could say the Wall Street Journal is echoing that same point. That this is hardly what we would call inflation fighting, what the Fed is doing. Again, because they're maintaining interest rate too low. But you're not hearing it from the New York Times. You're not hearing it from the progressive left, from Joe Biden. There's the same kind of idiocy about the nature of price inflation, which I'm almost embarrassed that it sounds as though I've been talking in complicated technical terms by saying, look, if there's a fixed money supply, how can there be a rise in prices? But again, I'm almost bothered. I'm making it sound more complicated than it needs to be. Back in the 1970s.
I actually think the analysis has been highly worthwhile because I'm never aware of like the technicals of, I guess, how, like, what exactly the Fed's doing in relation to the banks, or like, so you're giving us a lot more of like the technicals of how this actually takes place and some of the key indicators they should be looking at. So I actually think this has been very worthwhile.
Okay, I mean, I hope I'm not admiring us in too much of these, the banking stuff where our eyes were glazed over. But I wanted to just recall the past that I lived through in the 70s. President Gerald Ford, he was president for a while. He flashed buttons that were called whip inflation now, and so he felt that if everybody were to wear a button called whip inflation now, we could whip inflation, and that was the president of the United States and his advisors. And so what did that mean? It meant sort of like, you have to buy less, you have to participate in this whipping inflation now by buying less. But he's talking to people of limited means who are trying to scrape by, who are trying to keep up with the inflation by earning more. And I'm mentioning that only because that was like the ultimate idiocy. At least Biden is not flashing buttons called whip inflation now, as though all we have to do is wear a button and buy less, and we can whip inflation now. The point I'm only pursuing is that there's such a fog of misunderstanding on Capitol Hill and in the media about the nature of this price inflation that I think that's going to contribute to allowing the Fed to continue the policy that it's been pursuing, which is not really to cope with the inflation. Such a gross misunderstanding of the simple points I'm trying to point to that most economists sort of do understand, and so that will in itself mean that we are on that trajectory. Also, let me add a supply side point, which you might think gets a little bit far afield to what I've just said. You do have supply side pressures, but the supply side pressures are sort of on the Federal Reserve. The supply side pressures are the businesses and labor respond by what you said earlier, which is that suddenly your whole outlook, even if you're a discounter like Walmart or a discounter like Amazon, suddenly the atmosphere changes and the orientation is to raise prices and raise wages. So that dynamic starts in the marketplace itself. And as that dynamic begins to build, it would get nowhere if there weren't an expansion in the money supply. So you need that part of it as well. But it puts pressure on the Fed to respond to that pressure to expand the money supply in response in order to accommodate those factors. More or less, actually, going back to what we're talking about with the oil shock. If you accommodate that motel and keep expanding the money supply, then maybe you'll avoid those widespread bankruptcies. And so I'm only trying to point out that the wage price spiral can happen, but it can't happen in a vacuum. It happens by operating on the Fed, on the dynamics by which the Fed expands money balances in banks, and banks can lend to businesses that are raising prices and consumers that are getting more wages. And it starts a sort of the kind of dynamic that did take place in the 1970s. And you actually read about the Weimar Republic when there was 100% inflation, and they said you need to throw more money in the system. People need more money in order to operate. Indeed, they do, because otherwise there's going to be a wave of bankruptcies. They were talking those terms in the 20s. So I'm talking about a key dynamic that will put pressure on the Fed to keep expanding the money supply. In the case of the 1970s, as you may know, Paul Volcker was appointed as Fed chairman by Jimmy Carter, a Democratic president. But Volcker, then under Ronald Reagan, and I believe Reagan actually played a role there, Volcker recognized that in order to break the back of a price inflation that kept building and building, that was up to 12%, 13%, he had to disappoint the market. And to disappoint the market's expectation for more money, he had to bring about that wave of bankruptcies. And he pushed the federal funds rate, although he did it somewhat surreptitiously, up to 22%. We're talking about a federal funds rate that's now less than 0.5%. He pushed it up to 22%. He knew that would bring about a recession. It brought about up to that, at that point, the worst recession since the Great Depression. That unemployment rate, by the way, in the early 1980s was 10%, very much similar to the unemployment rate of the 08-09 downturn. So he brought about a very severe recession by breaking the back of the inflation and starting a new kind of regime at the Fed that was much more hawkish on inflation than ever before. So he had the courage to do that, and he did have the backing of Reagan, who I believe actually Reagan, ironically, was probably knew more about economics than most presidents who ever existed. I think Reagan knew what he was doing as well, and so Reagan was able to suffer that massive recession, and in 81, 82, that actually began to break the back of the inflation. And then
was that in his second term?
No. In Reagan, no.
Oh, wow.
No. Reagan was 80 and 84. He began in 84. It was his first term. I'm getting a little bit into the swamp of the politics of it beyond what I literally know for sure. But certainly, it was actually. I will tell you, I did a number of interviews with Milton Friedman, who's the famous, monetarist, and he was the one who made that point to me. that Carter had there been a Democratic president like Carter still in power in the early 80s, Volcker would not have been able to do what he did. But I mean, it was very destructive, but it was very courageous. But I would also add that certainly that ushered in a wave of hawkishness. Although, as I say, compared to now, the Fed was hawkish from 1960 to 2010. Now we've really gone crazy. But Volcker was very hawkish on inflation, recognized that inflation is a fool's bargain. He continued in charge. He did hand it over to Greenspan, Alan Greenspan, in '87. Greenspan began to abrogate a lot of what Volcker was doing, but more or less kept in mind the point about inflation. And then you're letting me go into a long story, but I will say that the supply side part of it is a factor. The pressure on the Fed to expand the money supply really receded in the 1990s, partly because of the end of the Cold War, partly because suddenly a lot of cheap labor became available abroad. Businesses needed less money to operate because they were suddenly hiring cheap labor abroad. The globalization that came with the end of the Cold War caused a disinflation. And of course, the other part of it was that because of the end of the Cold War, military expenditures fell, and so that too put less pressure on the government's need for debt. And so there was another factor. So I'm giving the whole long story of price inflation. I could continue with it, but maybe you want to ask a question, jump in and get back to the present day. Yeah.
No, so here's my next question for you. So we've got a picture here where M2, it's increased by 40%. We're starting to see inflation. The Fed's having to buy more of its own debt to try and kind of to keep that Fed funds rate down and to kind of make it seem like that government can finance its debt at, rates beneath the current inflation rate.
Yeah. You learned your grammar. Go ahead. Yes.
So it would seem to me that with the dollar, on pace to lose more and more of its value, do you think we have any risk here of other countries going, why am I holding so many dollars? Why am I transacting in this? Can we hit a level of inflation where more countries go, hey, I can't afford to be holding dollars?
Yeah. I'm a little skeptical that that's going to be a problem right now. Partly because when you think of the dollar, you have to think compared to what, and Europe seems to be having more trouble than even we are. I mean, Europe has always been screwier in most of its policies in terms of economics than the U.S. So compared to the euro, how's the dollar going to do? China. That's the Chinese currency, the yuan, or it's called the renminbi. How is China doing? It's a mismanaged economy. So what I'm trying to argue, just in broad brushstrokes, that I'm a little skeptical because as much as the U.S. is screwing up, I believe that Europe, its problems with energy by the far greater, and its monetary expansion is probably greater. Usually, if the U.S. is screwing up, the Europe and China are screwing up even worse. Of course, I guess I've stated something about China that sounds a little bit off the wall because we're supposed to think that China is such a bunch of smart people. But of course, I think they're basically a screwed up centralized economy. They've marched in the wrong direction. And so compared to the alternatives, I don't think the dollar in relation to other currencies is going to decline. But I do think that down the road, down the road, it's possible that that Bitcoin, that gold could be. I shouldn't say gold. I should say Bitcoin. That Bitcoin or cryptocurrency could replace the dollar. I think it's a little too early for that to happen. I think Bitcoin has to build in price. I think it's years away. And so I hope that answers your question. I'm saying the dollar compared to what? What's the alternative? The dollar has to be valued in something, and I'm skeptical that the world is going to turn to Chinese currency or to the euro or to the yen or to the British pound as an alternative to the dollar.
So I do have to ask about
but go ahead.
Sorry, the Chinese currency, it's called, you said it's the yuan, or how's it
It's
pronounced?
called the yuan, I forget why it's called either the yuan or the renminbi. The renminbi,
Renminbi.
it's not a dance. RMINBI, renminbi,
Right.
but it's more commonly referred to as the yuan, probably because we guys you can
So
pronounce
the
Chinese.
claim with China was that they, I mean, this was Trump's thing. He used to say that they engaged in currency manipulation.
Oh
I
yeah,
do think that China does not want the value of their currency to increase because they mainly export. And
yeah,
so
yeah,
that seems to be kind of a long running story with them. And I think in broad terms, some of the mechanics of that was that they bought a lot of foreign debt. So they wouldn't let like basically profits back into the country and increase the value of their own currency.
yeah.
Um, Now there's talk this past week, it was in the Wall Street Journal about Saudi Arabia being in talks about maybe pricing more oil contracts in yuan and basically, you know, selling directly. But when I saw that, I was like, you know, there's been this long running story of kind of the petrodollar and maybe other, but it seems to me like other currencies don't want to appreciate. Like it would seem to me that like
I see.
perhaps that even China wouldn't want that because that's been kind of against their entire economic strategy for the
Yeah,
last, you
yeah.
know, 30 or 40 years.
Yeah. Well, no, that's that sounds like an additional factor that sort of it's really, you know, what we call mercantilism in a way. It's this myth that you get rich by selling a lot of your goods abroad, when of course, obviously, uh, a simple-minded person would say, have, you know, you only get rich by acquiring a lot of goods, not by
Right.
selling. The next part is you sold a lot of goods, you want to acquire a lot. But the dominant elements in many countries, certainly like China, want a cheap currency so they can sell more rather than an expensive currency so they can buy more. And one would think it's a two-edged sword. If the dollar is cheap, for example, then obviously our manufacturers can sell more. But if the dollar is cheap, then you and I buy less. So it's a two-edged sword. But getting back to your point about whether the dollar is going to decline in value, as you indicate, there's the Chinese probably don't even want it to happen. On the other hand, I think it can happen. There can be. I think that if we're going 10 to 15 to 20 years down the road, and we hit the potential for a really severe fiscal crisis, it could be, for example, a flight out of dollars that are invested in our stock market. There's a massive amount of foreign money, and first of all, invested in our bonds. 1/3 of our bonds are held by foreigners. More than $1 trillion worth of U.S. Treasury bonds are held by the Chinese central bank. You know, a joke I like is if the U.S. goes to war with China, it will have to do it. It will have to finance the war with money it borrows from the Chinese. You know, we're gonna go to war with a country that owns over $1 trillion worth of our debt. You know, that's kind of unprecedented. Although, of course, the Chinese actually have not been acquiring more of our debt over the last few years, but they came out of nowhere. Starting in about 2000, they started buying up our debt like mad, and they're up to over $1 trillion. The Japanese own over $1 trillion of our debt, and so getting back to the scenario that I mentioned, if there is a major fiscal crisis, if there's a collapse in our stock market, there'll be a lot of selling of stock by foreigners, so we could have what has been alliteratively called the Dow dollar death spiral. People, the foreigners, start dumping stocks, and but in that case, they're dumping dollars. And then if the dollar declines, then the value of their stocks decline even further because in terms of their own currencies. So they dump even more, and that could cause bad times. But I guess I want to speak when you and I were speaking the other day, just informally, because I want to speak about the fact that there is a desire on the part of the traders of the world to trade in one currency, and that the free market generally gravitates toward one currency because that facilitates trade, and the dollar has been the convenient choice. I do dissent from those who think that it's all a plot on the part of those brilliant people in Washington who often know nothing about economics to keep the dollar dominant in the world. I don't think they're smart enough to know how to do that. I think it's basically been determined by the market that the dollar has become dominant because it facilitates trade in the world. and that for things to be priced in dollars simplifies trade, and so there's a preference to hold dollars, and that's that's kind of a network effect that's difficult to alter. So all of the predictions, for example, that Peter Schiff has been making, that the dollar is going to decline in value, it hasn't happened month after month after month. I don't think it's likely to happen over the next couple of years. But I've been wrong before, so who knows? But again, I think that the dollar
isn't that what makes being an economist such a lucrative profession? Is you get to be wrong a whole lot.
Well, I like to think of myself. I guess I'm perverse that way. When somebody calls me an economist, I like to say, no, I'm not an economist. I'm actually a social commentator, and I've learned the only thing I've ever learned is that if you really going to understand what goes on in the world, most subjects like history and sociology and psychology are not that difficult to grasp. But economics is a little bit challenging. So if you focus on learning economics, then the rest comes easy. You and I want to comment and interpret the world. So I'm an interpreter of the world, and I don't make my living making investment recommendations, and so I don't like to think of myself as a forecaster. If you ask me about what my expectations are for what's to come, I will talk about it, but that's not what I primarily do. I primarily try to interpret what goes on in the world, just like you do, Rob, and with a special knowledge of economics, because economics can be hard. You want to master economics in order to be able to interpret the world. And I like to argue that economics is really not that difficult to master, so long as you recognize that it's not a mathematical branch of physics. It's just a fundamental understanding of a few principles that I've tried to exemplify in our discussion so far.
All right. So, Gene, we're an hour and 10 in. Do you want to do a part 2 right now on the second part of the book, which is the unintended consequences of government interfering with free markets, or do you want to save that for another Saturday?
I tell you what, Robert, let's save that for another Saturday.
All right, because dude, I've learned so much. The thing with the episodes with you is I got to go back and re-listen to them. Yeah. Because even sitting here, I hear it, I understand it, and then I almost need a second listen to really absorb it and make an information that even I could repeat and sound confident with.
Well, you've done pretty well, Rob. Again, you like to summarize, you listen intently. I like the fact that this time around the screen didn't freeze over as it did the last time, and it froze on you where you were shutting your eyes and looking like you were bored to tears. You've had a very lively face the whole time and asking good questions, jumping in, accepting corrections from me. So once again, I commend you, Rob, on the quality of your interviewing. I guess I want to lead with one final statement. Milton Friedman, who definitely deserves a lot of credit for understanding more or less what I've been describing, although I've just mentioned Austrian economics a little bit that Milton didn't completely understand. But when he said inflation, I would say price inflation is always and everywhere a monetary phenomenon. It requires an increase in the money supply. That should sort of be a no-brainer. Although I will add to that and say that an expansion of the money supply is kind of necessary to a price inflation. It's a sine qua non. It can't happen unless you have a price inflation, unless you have a monetary inflation. Price inflation cannot happen unless you have a monetary inflation, an inflation of the money supply. On the other hand, it may not be sufficient. There are other factors involved, and the factors that are coming into play are we have a tight labor market, so wages are rising, and we have indeed supply chain problems. So in a way, I'm conceding your point. So there's a kind of a supply side pressure, but the supply side pressure is operating on the Federal Reserve. It would not mean anything at all if there weren't an institution there that's expanding the money supply. On the other hand, so that's why my portrait has been a little bit complex, because I'm not discounting, I'm not ignoring the fact that there are legitimate supply side pressures involved. And then I guess I should add once again that the source of this increase in the money supply is the government. The government sells its bonds to the Federal Reserve. The Federal Reserve prints money to buy those bonds. There's been an explosion in those bond purchases over the last couple of years. And so that's the link, that why the federal government is at the source of this, why the fiscal policy is at the source of the monetary policy. The fiscalists need to sell their debt. They're selling their debt to the Fed. The Fed is printing money in order to expand the purchase of that debt, and that has led to an expansion in the money supply, which has in turn led to the price inflation. And I guess I'm talking too fast in order to summarize, but that's more or less it, Rob. And so listen to what I've just said, slow it down and listen to it step by step, and then you can grasp it all.
This has been great. Thank you so much, Gene. Always a pleasure. And we're going to have to schedule another one soon so we can finally do part 2 in the series on bleeding heart capitalism.
And I look forward to seeing you, Rob, in the flesh at the Soul Forum on April 11th, Monday evening, along with all your other fans. Thanks a lot.
Beauty. Have a great one.